Welcome. My name is Van Richards. I'm a chartered financial consultant, and I'm here today to teach you about different stocks and how they can help you to accomplish your financial goals. Today, I'm talking about a really interesting stock that is a streaming stock. I'm talking about Spotify. So as we begin in today, I think you're really going to enjoy all the information that we have today. And so there's going to be some surprises about today. So let's go ahead and begin with today's daily stock analysis. Thanks for joining me today. If you're listening on the podcast, make sure you follow me so that you get the updates when I broadcast. If you're listening on YouTube, make sure that you hit the bell and the like button so that you get notified when there's new broadcasts that become available today too. I do these shows live, so if you have a comment, you have a question, go ahead and put them in. And during the show or at the end, hopefully I can get to your comment. If it pertains to what we're talking about today, then I'll try to include it in. If it's just a question about investments, I'll try to get back to you, make a post after the show. So as we're talking today about Spotify, I was really intrigued with Spotify for one particular reason. I do a YouTube show and I do it on a regular basis, and I've got a fair amount of subscribers, and I've started to do a podcast. And what really surprised me was the number of people that listen to this show on podcast and the platform that they listen to it on. I've listened to Apple for a long time. I have an iPhone, as many of you do, but what I found is that there are actually more people out there listening to me on Spotify, and that's just not me. It's a lot of other people in podcast world. They're listening to their podcast on Spotify. So as we go through today, you're going to learn a lot about Spotify. And some of you may be thinking Spotify is too expensive and they're not profitable. Why would I want to buy a company that's not profitable? Well, let me tell you what, you're going to learn why today. So let's go ahead and begin and talk about how this company works. But the first thing that I want to do is I want to talk just for a brief moment about our sponsor. Our first sponsor is my company, which is Richards Financial Planning. And I want to start that by posing a particular question to you. Have you ever heard anybody say, I regret sorting out my finances? The reason is no one ever says that. No one. You can control your financial future, and a financial plan can ease your financial frustrations. The easiest way to do that is to go over to richardsfinancialplanning.com, and you can ease your financial frustrations. Go over there today and learn a little bit more about the company. All right, let's go ahead and talk just more about Spotify. Some of you understand Spotify because you have the app, but let's learn a little bit more about the history of the company and where they are right now and why they're possibly going to make profits or why they're not going to make profits. So for those of you who are watching, let me make this the screen just a little bit larger so that we can see what's going on. Now, Spotify itself is really a music streaming and podcast company. They have two different revenue sources, the paid subscription model and then the ad-based model. They have 155 million paid subscribers, but they have 345 million monthly active users. They offer them 70 million tracks of music plus the podcast. They're in 170 markets, and that's growing. Now, here's the mystery. The stock value is continuing to grow, but they are losing money on paper. Why is that? That's the big mystery. Before I did the show, the stock was valued at $313.66 per share. They were down 2.81%, but just a few moments ago, I checked it and they're down a little bit more. They're getting hit a little harder today. They were at 307.82, down 4.73%. Now, you need to be thinking of this stock in this way if you're interested in buying it. When is the buying opportunity and what's the potential going forward? The company itself is worth about $59.66 billion. It is a large company, but when you compare it to some of its competitors, it's not as big as the Amazons, the Googles, the Apples of the world. But you're going to find that that's not the only competition that they have. Now, when we look at a stock, we look at three different things. I call it SEC, or it's the stability, the earnings, and the competitiveness. And the very first thing that I encourage people to look at is the moat of the company. Now, remember, the moat is that invisible barrier that's between the company and their competition. Now, I think personally, my professional opinion is that Spotify has a narrow moat. If you go over to Morningstar is going to say they don't have a moat at all. This is the reason why I believe that Spotify actually has a moat. The network effect is working really strongly in the favor of Spotify. And what I mean by the network effect is this. You have a very large user base. And the more people that use it, the more people that use it. They continue to grow, not just because of the advertising of the possibilities or the greatness of Spotify, but just people begin to use it more because they know people that use it. And as the user base increases, artists who have their music or their podcast on different platforms focus on Spotify and begin to use it more. They actually negotiate with Spotify directly through independent distributors, and they circumvent the big three music labels. We're going to talk about that in just a few minutes. And then as all this grows, you get more artists, you get more users, and then they are able to have more advertising. You know, that 155 million paid subscribers is significant. But another significant aspect is that $345 million monthly users, because those people see ads. And the more people, the more artists, the more ads, the more money. Spotify has a proprietary, if I can spit it out today, proprietary assets. Now, what do I mean by that? They have what I call micro user data and macro user data. The micro user data is they actually have an algorithm that as you use Spotify, it finds different types of streaming media that you like, and it presents it to you. One writer that I read said basically it's for people who are too lazy to make a playlist. Well, it's not just people who are too lazy to make a playlist. It helps you to see what else is out there, what genre fits your mood, what type of music fits your preferences. And it's very accurate. You should try it. I love Spotify's algorithm. That's the micro user data. The macro user data is the demographics and the music preferences. They have such a large base of customers, that 155 million subscribers and that 345 million monthly active users. All of their data is made available to artists, and artists can see what their fans like. And they can do that through Spotify. Spotify makes that available to them. And that's why there's more artists that are flocking to Spotify. Now, I made a really cool graph. If you're listening on the podcast, I encourage you to go over to YouTube, on the YouTube channel for Richard's Financial Planning. You'll find it. It's YouTube let me put it this way. It's youtube.com/C/Richard's Financial Planning. And you'll find the YouTube channel. And when you go to this slide, as I'm referring to it as, it's called Profit and Loss Comparison. And what I'm doing, if you're just listening to this, I'm going to describe it to you. What I'm doing is going back to 2016 through 2020, and I'm looking at the company's revenues in total. And you're going to see every single year it's increasing. 2016, 2.9 billion. 2017, 4.09 billion. 2018, 5.25 billion. 2019, 6.7 billion. 2020, 7.88 billion. It's increased every single year. Now, here's the really crazy thing about this. If you look at the profits of the company, it shows negatives every single year. In 2020, when they had $7.8 billion in revenues, they had $293 million in losses. Why the heck is that? And why would you want to buy a company that's losing? Here's why. Because the company's continuing to grow in stock value. The reason it's continuing to grow in stock value is because they are focusing their efforts toward research and development, the algorithm information, and also the other different types of research and development that they do, and sales and marketing. That's getting not just new users, but new artists. If you look at 2020, for example, yes, they had $293 million in losses, but they spent $1.029 billion in sales and marketing. If they cut that back $293 million, they're still going to be spending about $800 million on marketing, but they could show a profit. But that's not what they're trying to do. They're trying to keep up and keep ahead of companies like Amazon, Google, and Apple. And it's actually working to their favor. It's working to their favor a great deal. So let's keep going on and look at this just a little bit further, because when I'm talking about a company and I'm talking about their profits and losses, I think that it's real important, especially with a company that's showing losses, is to look at what their financial situation is currently. And one of the best ways to do that is going to be looking at an accounting ratio that's called the current ratio. It's really a simple ratio. You take the current assets, divide it by the current liabilities, and you get the current ratio. Now, if you compare that to companies out there in the world that are existing, you can kind of get an idea of how healthy the financial situation is for this company. In other words, are they going to be able to pay their bills? Now, the current ratio right now is really very good for Spotify. It's 0.82. And if you compare that to all other industries that are publicly traded right now in the United States, at about 1.55. So that's really pretty good. It's generally considered good if it's in between one and two. Now, one bearish aspect that you have to look at, though, is going to be how the ratio is interpreted. You know, you heard the bear there just for a moment. But the consideration is, some people might say, well, the ratio is too low. I think that they're wrong. The reason is this: a low current ratio shows that they have a strong cash flow. That's a very positive thing. Also, we want to look at the debt equity ratio. And this is the last one. We're going to move on from this. But the debt equity ratio right now for Spotify is 0.21. When you compare that to all industries at 1.01, their debt to cash equity is really good. Now, if you look at the earnings, and remember, when I'm talking about a company, I look at their SEC, their stability, their earnings, their competitiveness. And when I get to the earnings, usually what I want to see is growing earnings. It's a little different with Spotify. And the reason is this: with Spotify, their content acquisition cost is variable. They can't determine what that is on a regular basis because they don't know how much it's going to cost to get Taylor Swift, or how much it's going to cost to get Bruce Springsteen's podcast with Barack Obama. They don't know that exactly when they're putting things together. And they might have to pay more in some quarters than others, so it might make their earnings look really crazy. In a few moments, you're going to see that the earnings payoff is the actual share value. Spotify's earnings are variable, but remember, they're going to change. It's just the way that it is. Now, I have started using short interest as a factor that talk about with a company because it relates to their stability. If you look at a company like AMC or GameStop, they are being shorted like crazy. And remember, shorting is this: shorting is a broker is basically taking stock, they're borrowing the stock, they're selling it, they're keeping the cash, and they're hoping that the value goes down. Now, even though that Spotify is pretty high in value, you're going to find that the short interest on Spotify is reasonable. They have about 190 million shares that are outstanding. That means that's the number of shares that the company has authorized to be issued. The float is the number that people actually hold. There's about 115 million shares which are held by shareholders. Shares that are being shorted are only 3.72 million. And what that means is that the float is only 9.965%. What's that mean? Well, let's compare it to other companies. Like when you looked at AMC or you looked at, GameStop, their short float interest was really, really high. It was over 100%. And that makes the value very, very unpredictable because of they're victims of whatever the market is going to be doing. All right. I think that a really good barometer to look at for a company is going to look at the institutions. Look at where the big money is going. If you're on YouTube, you're going to see the companies that right now are buying. When I say right now, the most recent data that I have off of filings, government filings, is from December the 31st of 2020. And you're going to see that there's companies like Jensen Associates, JP Morgan Chase, ARK Investment Management, T. Rowe Price, Morgan Stanley Brokerage. Those are the top 5 companies that are actually buying the shares. And at the end of at the end of December, there were about 5,789,528 shares that were new shares. You're going to have companies like ARK Investment Management that actually increased their holdings by over 100% in what they're buying with Spotify. So they have a strong faith in that this company is going to do well. Now, you have to look at the other side too, because there are some investment managers that are negative about this. We'll talk about that in just a moment. But I found this really interesting because when I looked at Morgan Stanley Investment Management, in other words, this is the management company that's managing people's money. They sold out 100% of their Spotify shares compared to Morgan Stanley's brokerage accounts, which increased their holdings just by a little bit, only 3.1%. It went up 555,000 some odd shares. In total, though, if you look at the number of sellers versus buyers, there are actually more sellers. There are more shares sold in the last half of 2020 than there were buyers. So that's something that you have to keep in mind. Now, why are they doing this? Because Spotify has done amazingly well. Now, I used yesterday's price when I put this spaghetti graph together, but I went back a year and I looked at the price of Spotify. On March the 2nd of 2020, it was worth 139.34 cents. $139.34. All right. It went up to $321.28. Remember, today's really at $307.82 the last time I checked. But even still, that's over 370% in the period of one freaking year. That's why that it's volatile, is because it is slightly overpriced. But you have to understand that if you love this stock, look for dips. If today's a dip, that's what you want to be looking for. Okay, just a moment. I'm going to take just a real quick moment and thank our second sponsor of the day, which is actually Advice for Life Insurance. Let me say this, friends. Your family needs you. Protect them with life insurance. You know, you can find the best life insurance at the lowest price in less than 5 minutes over at adviceforlifeinsurance.com. All right, let's talk now about what the Bulls and the Bears are saying. The Bulls are roaring with Spotify. The biggest thing that I think is a big advantage with Spotify is that 25% of their total monthly users are actually using podcasts. And I have found this personally. I'm going to show you my numbers in just a moment. The growth is actually helping Spotify negotiate deals with artists, because artists are seeing that they have 345 million monthly users. These are people that could be listening to their art, their music. That's why they're using Spotify and why they're making direct deals with Spotify through independent distributors rather than going through the big 3 name labels. Spotify also gives artists an avenue for independent distribution. If you're looking at the screen, sorry that I misspelled independent. I can spell honest. And the fourth thing is Spotify has that big network effect. Growing users, increasing artists, increasing content. That's what's making the big difference. Now, when I started using Spotify for my podcast, this is what I noticed. 43%. Now it goes all over the world, but 43% of my content is being listened to on Spotify. Only 11% is being listened to on iHeartRadio. Then there are some other known Apple apps. I was really surprised that Apple Podcast was down so low. It was 8%, and I think that's pretty endemic. But friends, ladies and gentlemen, the bears do roar on Spotify too. There's some negative downsides to it, especially with a stock that is so highly priced right now. Apple, Google, and Amazon have more to invest, and they can drop, $100,000 into a project with no problem, because you've got Apple that's worth over $2 trillion. You've got Amazon that's worth about $1.5 trillion. And it's really, really easy for them to drop money into development and bury a company like Spotify. But Spotify is continuing to survive. The second is content acquisition cost is very unpredictable. What do I mean by that? Well, the artist and how much they charge can be unpredictable, but also the labels. There are 3 labels that are out there that really dominate the music world. Universal Music, Sony, and Warner Music dominate what's going on. And they can actually raise royalty fees. So acquisition cost is very unpredictable. What's the valuation of Spotify? Well, when we look at it compared to what Morningstar is saying that it's really worth, when I did this, is it with 319 today? As I mentioned, it was around 307. They're actually saying the fair market value of Spotify is only $174. That means, in the opinion of Morningstar, this company is selling at about 83% over top of what it's truly worth. But there are still analysts out there that are hitting the bell to buy Spotify. Out of 20 different analysts, there are 8 of them that are actually saying a very strong buy. One says moderate, but then 8 of them are saying hold off. We're not really ready to buy more at this point in time. And then we have 3 of them that are actually saying, hey, get the heck out of Dodge. This company is overbought. But let's compare Spotify to its peers. And what I mean by that is this. Spotify is worth about, let's say, $61 billion. When we compare it to Apple, Apple's probably the closest over the past year as far as valuation. You remember that Spotify is up over 300% for the past year. Apple is up considerably too, not quite as much as Spotify, but Amazon is competing too. But you see what I was talking about a few minutes ago when I said that Apple and Amazon can drop $100 million as a loss leader for development and really make it difficult for Spotify? It's because of the value they have. Another competitor that's out there that is a considerable competitor is SiriusXM, and I use Sirius also. They recently bought Stitcher, which is a podcast platform. iHeartRadio is another. Now, it's small, but it's still something that you want to consider. But you have to see that the market for platforms for podcast and streaming is fragmented. And what I mean by that is there are some small players that are making some competition for Spotify too. Salem Media is done pretty well. Actually, they've done extremely well. If you look at the stock value in the past year, Salem Media is up over 100%. And they're only worth about $73.4 million. Intercom Communications is another one that's up over about 30%, and they're only worth about $694 million. Cumulus Media at $208.4 million is up. Well, excuse me, I'm wrong on that one. They're down about 20%. And Beasley Broadcast is another small competitor. They're right at about 30% too. And I have to look at this graph just a little bit more seriously from this standpoint. All right, let's keep moving on from the standpoint and see what the big wirehouses are saying about Spotify. The most optimistic price right now is coming from Rosenblatt Securities. And as of March the 1st, they are putting a price target on Spotify in between $390 and $425 per share. Remember, they're around $307 right now. So Rosenblatt Securities is looking for a lot to grow. Wells Fargo is the most speculative. They're saying that the company is overpriced. They're putting a price target right now on it at $215 to $200. All right. So, friends, let me ask you this question. What price do you think that Spotify is worth? If they're at $300 right now, and you've got one company that's saying it can go over 400, you got another wirehouse that's saying that they're only worth around 200. So there is a broad opinion that's on there. When I look at a company, I always look at the stability, the earnings, and the competitiveness. And I encourage you to do the same thing too. Spotify is just a little bit different. The reason is Spotify, on a regular basis, they show profits on their balance sheet. The reason they're showing losses, they're showing no profits. They're showing losses on their balance sheet. And the reason that they're doing that is they're pumping a lot of money into sales and marketing and research and development. From a management standpoint, it would be easy for them to cut back and show a profit on paper if they really thought that's the way that they were going to grow. But my opinion is that Spotify is continuing to pump money into acquisition of new artists so they can continue to grow and be a platform for artists. I also believe that going toward the future, that podcast with Spotify is going to be a strong motivator for their revenues to continue to grow. Will they ever get to a point that they actually show a profit rather than a loss? I don't know. But quite frankly, if they keep growing in stock value, who cares? You just have to understand that it is a volatile investment, and it's the Wall Street game. There's no guarantees. So with that, friends, I'm going to say that's the end of today. Be sure that you listen to the disclosure, which is coming up after the podcast, or if you're listening to this on YouTube, keep watching and you'll see what's there. Come back on another day, and I'll bring you up to date on another stock. Let me know what you like. I'm running out of ideas. Let me know what kind of stocks you like. Have a great day.